Hey everybody, it's 3:15. My name is Erica Plemmons. I am a senior economist with Bright MLS. Thank you for joining us today on our Mid-Atlantic Housing Market Update webinar. Today, we're going to be covering a variety of things. We'll talk about the economic picture. We'll talk about how the housing market metrics have been coming in. We'll share some results from our subscriber survey. And we'll talk about a recently and an upcoming released reports from Bright MLS. Now, I know we're all busy people, so if you have a commitment, feel free to hop off. This webinar will be recorded, and the slides from today's presentation will be available to you. Now, I know in the past there's been some issues getting the webinar content. So this month, we're going to be sending out a link directly from Zoom, and it will happen about a few days after this event that will contain where the recording and the slides are posted on Bright's website. But I know things can, not always work out as we plan. So let me quickly show you where on the Bright website you can find the information. If you are on the public-facing website, our navigation is in the top right corner. You would click on Research, and there's a sub-menu called News and Insights. This is going to have content such as our webinars, as well as other blogs and information. The most recent will be at the top. So you can see there is Webinar Housing Market Update, and you would be able to click that link and it would contain the video and the slideshow. You can also access it once you're logged into Matrix. You're going to see those same navigations, except it's going to be in your top left corner. And so you'll click on Research, go to News and Insights, and it will direct you to that page with that list of articles. So hopefully, if you're not able to attend the full thing, you can revisit it later and see some of the content you missed. But I'm hoping that you're going to stay tuned. We'll start with our economic picture. Now, the economy and housing go hand in hand. How the economy is faring will tie into how well the housing market can perform. When we look at our employment picture, there's been notable softening over the past year. Our top chart shows our monthly change in the total U.S. employment. So in August, our most recent month data, there was 187,000 jobs added. Actually, in July, the original posts showed 187,000 jobs added as well. But if you look at that chart, you see that those bars aren't the same size. And that's because job gains can be revised. And the July job gains were revised downward to 157,000. The June job gains were also revised downward. So if we look at our most recent month's bars, they're significantly lower than what we've seen in some of those past months. On average, over those past 12 months, there's been about 300,000 jobs added. So what we're adding currently doesn't quite compare, but still we're adding jobs and not subtracting jobs from the economy. If we look at the U.S. unemployment rate, our bottom graph, what we see is that in August, it was 3.8%. Between March of 2022 and July of 2023, the U.S. unemployment rate kind of bounced somewhere between 3.4 and 3.7%, kind of going up and down. And so now we're a little bit above that range, but it's still low by historic standards. The total number of unemployed in August 2023 was 6.4 million, and this compares to 6 million last year. So again, there are signs that things aren't maybe as great as they were, but the economy has still been strong and many times has been defying expectations of what was going to happen in 2023. Now, this is a picture for the U.S. overall. And while the Bright footprint kind of symbolizes the United States because we have our major metro areas and we have rural areas and we have suburbs, we want to look closer to home. And when we do that, we'll focus on 3 of the major metros in our Bright footprint. First, Philadelphia, which is our orange line. If you look at it, unemployment for the metro areas is lagged by a month, so we have data through July. The unemployment rate for Philadelphia was 4%. So that's a bit above that 3.8% that we saw in August for the nation overall. However, our Baltimore, that navy blue line, and Washington, D.C., the lighter blue line, are below the unemployment rate for the country. So either way, all of this points to a fairly healthy economy in our local markets. So it should be tying into how our housing market is doing as well. But one of the things we know that is fighting housing is inflation. Consumers not only have to contend with, we know home prices are higher, but the cost of goods in general has been higher. Overall, the Consumer Price Index, our CPI, the blue line, has been going downward, but last month it ticked upwards. In July, the year-over-year change was down to 3.2%, and in August, it was up to 3.7% year-over-year. So the Fed is usually aiming for a 2% inflation rate, and this is still a bit higher. One of the components feeding into CPI is shelter, and we can see it's been trending downward. It's that green line. On the other hand, with shelter, it is a lagged component. So we're expecting it to go down, but at some point, it's only going to go down so far because we know that there has been pressure on home prices, as well as rental prices have been lower, but there's also been a slowing then of building of multifamily units. Now, the Fed is continuing to track inflation, and they're continuing to kind of wrestle with it. As of their meeting yesterday, they decided that they weren't going to do anything with the federal funds target rate. But in their comments, there's a clear indication that there will be one more rate hike before the end of this year. And from what I've read from other economists, they're leaning towards that would happen in November. But of course, the Fed is going to continue to monitor what the employment data and the inflation data is doing before they make any decisions. We know that the Fed raising rates starting last March impacted our mortgage rate. Other things impact the mortgage rate as well, but let's just take a look. As of today, Freddie Mac reported that the average 30-year fixed mortgage rate was 7.19%. So the chart is very small. What is going on? I am so sorry that I have not seen this sooner. Can you not see this? Let me pause for a second and we'll start back with mortgage rates. The chart is small. Robert, can you confirm that?
It's showing on our end. I don't know if you want to just unshare and reshare it, maybe?
Unshare and reshare. We're going to stop it and we're going to share the screen again. Thank you all for telling me that. And I am sorry I did not catch that sooner. Okay, let me know now. How are you seeing the charts? Is this looking a little bit better?
We're getting thumbs ups.
Good, thumbs up. Well, thank you all for, bearing with that. And I'm glad you can see the chart better now. And again, you'll be able to get those slides so you can expand them to whatever screen size you have at home. So let's go back and catch up with what's happening with our mortgage rates. So this week it was 7.19%. In mid-August, it had reached that 7% barrier, and it's been above 7% for 6 weeks. So this chart only goes back to January of 2019. But if we go back to 2000, these are some of the highest mortgage interest rate levels that we've seen in the past 2 decades. So consumers are facing something that they're really not used to. And for a consumer, the difference between a 7% rate and a 6% rate can mean hundreds of dollars on that monthly payment. And that can be a budget breaker. So for our buyers, these 7% rates can be something that they have to really weigh and look at those numbers. Now, we are hoping that interest rates will ease. We know that the spread between the 30-year fixed mortgage rate and the 10-year treasury has been higher than it historically has been, but there's still that uncertainty in the economy as to whether we're going to have some sort of mild recession or if the Fed can navigate a soft landing. Either way, consumers aren't just contending with higher interest rates, they're contending with higher prices. So let's get into some of that price and other housing market statistics data. When we think about our housing market, the trends over the past few months have been really consistent. Prices are high, they're either firm or growing, and inventory continues to be very low. While we're going to talk about our monthly statistics today, I want to quickly plug our weekly market reports. Our research team compiles data for 5 metrics on a weekly basis for the Mid-Atlantic and the 9 metro areas. Now, we've received subscriber feedback that, metro areas are pretty large and some of our counties don't actually fall into some of those designated metro areas. But in good news, upcoming in, I want to say a week or two, probably 2 weeks, let's go 2 weeks, you will be seeing county level pages or like supplemental data with county information in those reports. So I encourage you, sign up for our weekly reports and you're going to get an email directly to your inbox with the link to them so you can receive the trends on a very consistent basis and you don't have to wait just another month for new statistics. Now, getting into our housing data, our August median sale price across the entire Mid-Atlantic was $401,000. Now, this isn't quite our high that we saw in June, but it is still very high. And I want you to focus on the white between our orange line, which is 2023, and the gold line, which is 2022. You can see there's quite a bit of spacing between August of 2023 and August 2022. The median price was up 5.5%. And this is actually the highest increase that we've seen so far in 2023. So prices are still growing, and if they're not growing, they're generally firm. This is the Mid-Atlantic, and I encourage, this is the time for you to dig into our reports, especially the monthly ones that already contain that county information, and look specifically for your area. But suffice it to say, in general, we're not seeing maybe those price declines that you see in your headlines for California or other areas on the West Coast. Now, why are prices continuing to be so stubborn and growing? Well, demand is affected by our 7% rates and even just the rate growth over the past year. But supply has been so depleted that it is continuing to put competition on buyers still in the market to put in good firm offers in order to win their homes. Looking at our orange again, that 2023 line, it is lower than what it was last year. For August, active listings at the end of the month were 11.4% lower than what they were last year. And this is the 3rd month in a row where active listings have been lower in 2023 than they were in 2022. Now, this is just comparing our recent times. We know that when there was the pandemic, there was this buying frenzy. We had ultra low rates and incentive to get into the market. So if we compare our inventory now to a more normal time before that activity happened, say 2019 and 2018, inventory levels are roughly 50% or less than what they were then. So buyers in today's market have very limited choices of what they can purchase. Is it going to change? Unfortunately, our new listing data isn't showing optimism for our inventory picture. New listings are at a 2-decade low in the Mid-Atlantic. And so that means even though demand is weaker, supply is still not adding. And we need supply to outpace demand for a significant period of time in order to continue adding and getting our inventory back to maybe where it was before the pandemic. We know that our transaction activity has been impacted twofold. We have the mortgage rates impacting our demand, our supply limiting the number of transactions that can occur. Pending sales before August, that gap between 2022 and 2023 had been shrinking, and we were getting optimistic. Maybe it was going to close. Maybe that orange line for 2023 would cross over 2022. But the gap widened in August, and the difference in pending sales between the 2 years was 17.3%. So we're going to have to see how the mortgage rates kind of shake out the rest of the year, as well as what happens to our inventory picture to see if any line crossing would occur, or if it's going to continue to trend below what we saw last year. Either way, the expectation, and as you can see in this chart, any color line you look at representing one of the years, we see lower transactions in the fall than we did during our spring and summer months. Pending sales will lead into closed sales. And because of that, closed sales are also not matching what they were in 2022. So we have closed sales in August of 20,600 across the Mid-Atlantic, but still this is 17.2% below what we saw in August of 2022. We're going to have to wait and see what happens to our transactions, and pending sales will give us an indicator of where closed sales are going to be headed in future months. Now, I'm going to go back to closed sales for a second, because, sometimes we see headlines and, there's sometimes doom and gloom, but we have to understand, yes, transactions are limited. They are not what they were last year. They aren't even at the levels that they were pre-pandemic, but transactions are still occurring. And so that's important to note. And we can find out more about the transactions beyond that MLS data that goes into our housing market metrics to understand some of the motivations of our buyers and sellers, what's happening in terms of our offers, and maybe what kind of obstacles or hurdles both buyers and sellers are facing. And with that, I'm going to turn to the results from our subscriber survey to give us some of those details. Now, buyers are still very persistent in today's market. And for those who are still participating and were successful in August, they don't seem to be as swayed by the mortgage interest rates. Now, about 20% of our agents and brokers who responded said that their buyer had paid with cash, so mortgage rates weren't going to impact their choice. But over 50% said that even if they use financing, that interest rates were not a factor in their decision. I also want to point out, though, that the one sliver, the yes, rates are headed higher, there are buyers that think rates are going to continue rising up, and so they'd rather lock it in now than wait and see what occurs. This, again, focuses on agents who've had a successful transaction. So we're missing the sentiment of buyers who've been forced to move to the sidelines. But hopefully, as we continue this survey and we continue modifying it, we can maybe include a question to get buyers agents to give us their perspective on buyers who are waiting and seeing. We have read through some of the subscriber comments on the survey that you're more optimistic about 2024. And in general, buyers are kind of just pausing to see if rates would go lower, then maybe they could make their budget work and move back into the market. But buying is still occurring, and one of the key factors of buying is the fact that the US demographics are supporting a large chunk of people wanting to buy, and that's the millennials. The millennials are at that key age of a first-time home buyer. It's no surprise then that first-time home buyers or people tired of renting make that top reason of why people are buying, and that's nearly a third of the responses. The next reason is family reasons, and this could include marriage, divorce, moving closer to relatives, having children, and needing kind of a different home. It encompasses a lot of, life's things that happen in your life. There are other things that are going to impact it that, are life events. You get a new job, you have a career change, you may need to move. We didn't ask specifically about this, but questions go in the Q&A, reminder, but comments in the chat. Feel free to type if you've worked with any buyers who have considered moving because their company is enforcing return to office mandates. It would be interesting to kind of see if that is a motivation for those who maybe have picked a location that was a little further out and now they're realizing that commute, if they're going to need to do it more often, isn't as feasible. And while there's going to be people coming into the office, there are also people leaving the office completely. We had 2.4% as their primary reason for buying was that they've retired and they now get a life of leisure. So congrats to them. Now, with our successful buyers, they didn't get to purchase so easily for most of them. Roughly 45% said that their top obstacle was finding the right home, and this was very or somewhat difficult. So nearly half are having difficulty finding that sweet spot, and that could be due to affordability. We know from our inventory statistics that there's significantly lower amounts of like affordable homes than there were in past years. Or it could be that they're trying to swap out homes. They're both selling and buying, and kind of finding what works is a little more difficult because they've got to get the stars to align. Following our obstacle of finding the right home, the next biggest struggle was submitting a successful offer. But what we found with this answer is it varied strongly by our buyer type. If we look at first-time buyers versus repeat buyers, one of them is having a harder time. Overall, buyers haven't been as successful on kind of a one and done offer. Generally, it takes around 3 offers for our buyer to be successful. Though 37%, as you can see, submitted 1 offer on that property and secured that home and made their purchase. But it isn't true for everyone. When we break this down, the green is our first-time buyer and the lighter blue is our repeat buyer. We can see the difference. 42% of repeat buyers could submit 1 offer and they purchased the home in August versus first-time buyers, it was down to about 30%. If we look at the other end of this chart, at the 5+ category, you can see significantly more first-time buyers have to put in 5 or more offers before they finally purchase that home. Another way that these buyers differ is by the amount of down payment they can put. For first-time home buyers, 62.2% put less than a 20% down payment. And if we go kind of further down, who put less than a 10% down payment? 60% of first-time buyers put down less than a 10% payment, and a quarter put down 3% or less. And this compares to those repeat buyers who maybe have additional savings or proceeds from another home. There's only 38.7% of them who put down less than 20% on the home purchase. Now, how much you can put down or maybe where you're coming from will influence your offer type. We were able to combine the surveys from our summer months, so June, July, and August, to understand where buyers are moving from. We wanted to compile enough data to have something that was more statistically significant. And you probably know when you work with buyers, many of them tend to move locally. We found roughly half, it was 47.3%, move just within the same county. About a quarter move within the same state, but just from one county to another. But then that roughly quarter that's remaining, they are moving across states. Now, across states could mean you're just hopping from, Maryland to Virginia or vice versa. Or it could mean you're traveling cross country. When we look at buyers who said that they moved from a different state, 46.3% moved from another state within the Mid-Atlantic region. So you can see our highest states are New Jersey, Maryland, Virginia, Pennsylvania, DC. So those are some of our high areas where people are moving just within the Mid-Atlantic region. But you also have people moving from further away. Now, New York isn't really that far away, but you have people coming from Florida, California, Texas, and North Carolina. So these are some of the areas where we're going to hopefully get to dive deeper as we continue this survey. So for instance, these top states are for the Mid-Atlantic overall, but as we compile more responses, we'll be able to drill deeper into say, which are the buyers in Pennsylvania? What are their most popular states? How about those moving to the Baltimore metro area? So I'd encourage you, if you've had a transaction and received one of these surveys, please fill it out because it will allow us to provide further analysis for you. Now, we've talked a lot about our buyers, but buyers are going to need sellers to list in order to be able to purchase a home. When we look at sellers who have decided to list in today's market, the primary reason for selling continues to be family. And following that, we have estate sales as part of the picture in the Mid-Atlantic of how inventory has been added to the market. On the other hand, there are some more discretionary moves. We have about 11% of people wanting a bigger home or an additional 11% wanting a smaller home. So they're kind of needing to trade sizes. There are also people wanting to take advantage of, where they think the market is today by selling a rental, a vacation property, or an investment. And then there are those who are trying to cash in on the equity gains that they've made, and they think now is the right time. But even though some listings and, we're seeing still multiple offers and competition, that doesn't mean sellers have a cakewalk. A lot of them are going to still face issues, and sometimes deals are not going to close. So we asked our listing agents if they've had more than 2 deals in the past 6 months to give us some feedback on some of the other listings they may have been working on, because the subscriber survey again focuses on ones that have closed. And roughly 6% said that they had a contract fall through because the home did not appraise. About 15% in our latest survey and 13% in the survey before said a contract fell through because of buyer financing. So those are some things that, you may not see in like the housing data, but these are things that we need to consider to help make sure that we're educating our buyers and sellers and helping those deals cross the finish line. With that, I'm going to finish up with some resources and some of those studies that you should either find now or look forward to later this upcoming week. So we talked about our weekly reports and our monthly reports, but did you know that Bright always publishes an annual on MLS study? And this year they found that for the last year, 2022, 85.5% of sellers listed their home on MLS. This is a benefit to both buyers and sellers. For sellers in particular, they found between 2019 and the first quarter of 2023, those who listed on the MLS sold their home for 17.5% more than comparable homes that were not on the MLS. And there's an interesting trend. You see how this shows us the trend over time each year? There's an interesting trend with what happened over the years of how much more a buyer receives by listing on MLS. So I'm going to leave it to you. Go ahead and find the report on Bright's website and dig into some of those details. The other thing you need to look forward to is next week, the week of September 25th, Bright has partnered with George Mason University, and they're going to release 2 different research briefs. The first is going to focus on the government's reaction to COVID-19 and how that's going to have long-term impacts on the housing market. And the second one is focusing on that the work from home trend and how there's going to be regional differences based on which companies maybe are more lenient or what kind of workers they need and how they're going to balance work from home and working from the office and hybrid. So I want to thank you for attending today, and I want to always share that our team is happy to help you out. Our chief economist is Dr. Lisa Sternovit, and she's always providing excellent commentary and presentations. So please find her on like social media, LinkedIn, and always see what she's posting. I have learned so much working with her over the past several months. I'm Erica Plemmons, and hopefully I'll be seeing you at our next webinar, which is on October 19th, same time, 3:15 on Thursdays. And we have a wonderful research analyst, Colby, who's always excited to dig into the data. So with that, I think maybe I can take a few questions and then we'll wrap it up. So thank you.